In January of 2015, just after mid-morning in Zurich, the Swiss National Bank released a brief statement. Within minutes, the Swiss franc rose sharply against the euro. Trading screens across Europe showed prices that no longer connected to recent history. Market makers stepped back. Some foreign exchange platforms stopped quoting altogether. By the end of the day, several currency brokers were insolvent, and a number of European banks were quietly assessing losses that would take months to surface. The policy that had anchored the Swiss currency to Europe's monetary system for more than 3 years no longer existed. At the time, the peg had been treated as durable. It had been defended publicly and repeatedly by the Swiss central bank, described as essential to economic stability, and framed as a firm commitment rather than a conditional arrangement. Its removal mattered not because of Switzerland's size, but because of what it revealed about modern central banking, market confidence, and the limits of explicit assurances in a system that depended on them. To understand why the decision resonated so broadly, it was necessary to step back to the conditions that produced the peg in the first place. Switzerland entered the aftermath of the global financial crisis with a currency that had become a refuge. Capital moved into francs during periods of European stress, not for yield but for preservation. The euro area, by contrast, was navigating sovereign debt crises, fragile banking systems, and political uncertainty. Each escalation pushed the franc higher, tightening financial conditions in Switzerland without any corresponding change in domestic fundamentals. By 2011, the pressure had become acute. Swiss exporters were struggling with a currency that had appreciated rapidly against their primary trading partners. Tourism revenues declined. Deflationary risks increased. Traditional monetary tools offered limited relief. Interest rates were already low, and further reductions threatened to amplify capital inflows rather than discourage them. The Swiss National Bank faced a problem that was less about inflation targeting than about managing external demand for safety. In September of that year, the central bank announced it would no longer tolerate an exchange rate below 1.2 francs per euro. The phrasing was deliberate. The bank committed to purchasing foreign currency in unlimited quantities if necessary. The objective was not to weaken the franc arbitrarily, but to draw a line beneath it, signaling to markets that further appreciation would be resisted. The policy worked, at least in its initial form. The exchange rate stabilized. Exporters regained some predictability. The threat of immediate deflation receded. Markets adjusted their expectations around the existence of a floor that appeared credible because it was enforceable. Unlike a verbal intervention, this was a standing offer backed by a balance sheet that could expand as needed. Over time, however, the costs of maintaining the peg accumulated. To defend the floor, the Swiss National Bank had to absorb large quantities of foreign assets. Its balance sheet grew to a size that was unprecedented relative to the country's economy. The composition of those assets exposed the institution to fluctuations in foreign markets, particularly the euro area. While the central bank could not technically become insolvent in a conventional sense, the political optics of large accounting losses were not trivial in a country with a strong culture of monetary conservatism. At the same time, the global monetary environment was shifting. Major central banks were expanding asset purchases. Interest rate differentials narrowed. In Europe, the prospect of a large-scale quantitative easing program by the European Central Bank became increasingly likely. For Switzerland, this posed a problem. An expansion of euro liquidity would place renewed upward pressure on the franc, forcing the Swiss National Bank to intervene even more aggressively to maintain the peg. Internally, the peg was increasingly viewed as asymmetrical. It protected against appreciation, but offered no natural exit. As long as European conditions remained fragile, the commitment required constant reinforcement. Each reaffirmation of the floor increased the scale of future intervention required to sustain it. The policy that had been introduced as a stabilizing measure began to resemble a permanent obligation. Publicly, the bank maintained its stance. Officials reiterated their willingness to defend the floor. Negative interest rates were introduced to discourage inflows, but they supplemented rather than replaced the peg. Market participants interpreted these actions as reinforcement, not preparation for withdrawal. The assumption that the peg would be adjusted gradually, if at all, became widespread. The decision to abandon it did not emerge from a single catalyst, but from a convergence of constraints. The anticipated actions of the European Central Bank reduced the Swiss National Bank's room to maneuver. Maintaining the floor in the face of large-scale euro asset purchases would require an expansion of the balance sheet that risked eroding institutional independence. The longer the peg remained, the harder it would be to explain its eventual removal without destabilizing expectations. When the announcement came, it was unaccompanied by transition mechanisms. There was no phased adjustment, no widened band, no advanced guidance. The central bank cited the changing monetary environment and the growing costs of intervention. The language was measured, but the effect was immediate. The exchange rate moved faster than most systems were designed to process. Prices reflected not only new information, but the sudden removal of a constraint that had shaped positioning for years. For market participants, the event exposed structural vulnerabilities. Many currency strategies had treated the peg as a fixed parameter rather than a contingent policy. Leverage magnified the impact. Risk management models, calibrated to recent volatility, failed to anticipate a move of that magnitude. In some cases, losses exceeded posted collateral before positions could be closed. The consequences extended beyond trading desks. Several retail foreign exchange brokers collapsed under the weight of client losses that became their own liabilities. Banks reviewed counterparty exposures that had seemed negligible days earlier. Legal disputes followed, centered on margin calls and execution failures. These were secondary effects, but they underscored how deeply the assumption of stability had been embedded. In Switzerland, the immediate economic impact was mixed. The franc's appreciation created headwinds for exporters and compressed margins in industries exposed to foreign demand. At the same time, lower import prices supported domestic purchasing power. The central bank adjusted its policy framework, relying more heavily on negative rates and discretionary interventions rather than explicit commitments. In the months that followed, interpretations of the decision diverged. Some viewed it as a necessary correction, delayed too long and executed abruptly because gradualism had become impractical. Others saw it as a breach of trust, arguing that the strength of the prior commitment had encouraged behaviors that amplified the shock. Both perspectives shared a common feature. They focused on the moment of abandonment rather than the path that led to it. From a structural standpoint, the episode highlighted the tension inherent in modern central banking between credibility and flexibility. Commitments are effective precisely because they shape expectations. But expectations, once established, constrain future choices. The Swiss National Bank had not misjudged the immediate effect of the peg. It had underestimated the difficulty of exiting a policy that functioned primarily through belief. The event was later cited in discussions about forward guidance, unconventional tools, and the communication strategies of central banks operating in open economies. It did not produce a single consensus lesson. Instead, it served as a reference point for debates about how much certainty institutions should provide in environments where underlying conditions can change faster than mandates. What remained striking was not the volatility itself, but how quickly it revealed assumptions that had gone largely unexamined. The peg had been defended successfully for years, and its existence had come to feel less like a policy choice than a feature of the landscape. Its removal reminded markets that even well-articulated commitments are contingent on conditions that may not be fully visible from the outside. In the end, the Swiss monetary system adapted, markets recalibrated, balance sheets adjusted. The episode receded from headlines, replaced by other sources of uncertainty. Yet the quiet question it left behind was not about the correctness of the decision, but about the nature of assurance in a financial system that relies on it. Stability had been maintained until it no longer was. The mechanisms adjusted accordingly. What remained unresolved was how clearly those limits had ever been understood.